Good morning, everyone. My name is John, and welcome to the Retiring Club. I think I had the Tesla effect where I got all these ideas overnight. So I just woke up, got myself together. I got a big Falcons game today. So I'm going to do this segment of the Retiring Club. And the objective of the Retiring Club is for us to come together and help each other develop and work on our retirement as far as planning, getting questions answered, and helping those who may not have the knowledge to get started and overcome some of the fears of retiring. So, right now, I've got my screen up here, and we got a couple of different options. So, you've got your typical investments where you do the pre-tax. The pre-tax, they take it out of your check. You don't pay any taxes on it. It goes into the 401k, the 403b account, and you have selected an investment, and it's a percentage of your income. You don't pay any taxes on it. If you get in trouble and you're under 55 years old and you start taking that money out, you get hit with a 10% penalty, as well as you have to pay the taxes on that money. So there are benefits in doing this series. We are going to do what I call a balanced approach. For the long term, if you are investing for your retirement, you want to go with the pre-tax. And here's the reason why. Th- There's a rule of 55, just in case in your age you get laid off. You want to have that money. And here it is. This is the rule of 55. If you turn 55 during the calendar year, you lose or leave your job, you can begin taking distributions from your 401k without paying an early withdrawal penalty. However, you still pay taxes on your withdrawals. This rule of 55 is how a lot of folks in the FIRE movement, financial independence, retire early, are coming out of work. Now, some people are coming out of work because their jobs have ended. You've been retired. They say, hey, your position's being eliminated. Here's what we're going to do. We'll give you, your benefits through the end of the month, and we'll give you 2 months of full pay. But your job is gone, and after you sign these documents, you're no longer employed. This happens to a lot of people, and rather than going out looking for another job, trying to get a comparable pay, going through those background checks, drug tests, credit reports. They're like, just screw it. I've got enough money put away. I'll use the rule of 55 and I will stop working. Now, if you're a younger person, like the audience that I'm trying to get to, you're going to want to fill up this account, the 401k, that will allow you to execute the rule of 55 down the road. So that's a good one. But this is what I'm doing right now. I'm doing what's called a Roth IRA. 5 years ago, I started a Roth IRA with $5,000 in a technology fund. And that technology fund, we're going to look it up a little later on. I'm going to show you how to look it up and see what the investments there are. But anyway, I started that investment with 5 grand. I didn't even buy the shares. By deposit, opening an account and putting money in it, I started the clock. And what that clock says is that over the next 5 years, the money you put into this account, you can always withdraw it out without any penalty or tax free. The Roth is strictly pre money that you've already paid taxes. Like you getting a big sum of money, you've already paid taxes on it, and you're going to the bank and you're putting it in. Except with this Roth investment, you're able to put it in investment vehicles that can grow over time. So that's what I did. And I got the clock rolling, and I made some contributions to it over the years. And I set up a simple goal. It was $100 a month. And after a year, with that 5 grand over the 5 year period, by putting in 1,200, and then I moved it down to 1,000 because I was putting away too much money and I was bumping up against the limits that you allow. which in this Google search, I did the Roth IRA at 55. This is going to save your tail because all the money you put into it, you can withdraw it out. So if you're saving into the Roth IRA or you start your own Roth account, like I did, and something happens and you have that budget set up, which by now you should have an idea of how much it costs you to operate your home and pay all your bills per month so that you can build up the 90-day fund. So you can actually use this Roth IRA to start putting money away to help cover yourself in the event of a job loss, as well as have the power of the stock market growing those investments. And we'll talk about a couple investments down the road. But the Roth IRA and the 401k, I believe in a balanced approach. I want to sleep good at night. There's some people who are losing their jobs now. Of course, you got unemployment, but what about the shortfalls? In the state of Georgia, with no taxes, the unemployment is $360 a month. So 360 times four is what you're going to bring home. What if your bills are running at $2,200 a month? Where's that money coming from? It's got to come from someplace. So that's why we're covering it so that when you can invest confidently for your best interest down the road because nobody else is going to do it. So we got the Roth IRA as an option and the 401k. 401k is going to be your long haul and it'll cover you in case you get laid off or let go. Okay, folks, I'm back with you. So we are going to take a look at how we can look at our investments. So at the office, when you go to your benefits website and you go over to your whoever's handling your retirement account, you're going to look up first, you're going to make a decision. Do I want to go with the pre-tax because I'm okay and I want to build this up with a goal to get into the first $100,000? Or am I more comfortable? Do I have enough extra income where I can afford to put it into the Roth where I don't have to worry about taxes because A, I want to buy a home, or B, I want to make sure that in my industry, I've been looking for another job, hadn't been coming out too well. If I get laid off, I need to cover myself. So what we're going to do is when you go to your website, and you look at all the benefit choices, you have the option, and once they come up, you can do screenshots or you can do file and print the PDF. You want to look for Microsoft print to PDF, and you can save that, and then you can print it out. You can have it because you could talk it over with people. Some of you folks may have a trusted advisor already in the family where your parents will say, "Hey, uh, give that to me and let me run it by our advisor," or they may say, well, why don't you call your advisor? He knows you're going to call. He knows that you're working, and you can give that to them, and they will make the choices and recommendations for you. But if you're just getting started out, I'm going to show you how you can go in and look some of these investments up and dig into them. So you're going to go to yahoo.com. Got to make sure this is working because I filmed earlier and the mic died, so I'm doing a retake. You're going to go to finance and you're going to come over here. And what you want to do is look for the ticker symbol. Now, I'm going to pick one that I'm familiar with and I'm going to explain a little bit more. I'm putting in this ticker symbol MDFOX. Let's see who it comes back from. BlackRock Large Cap Focus Group Fund, MDFOX. Its last trading price was $7.75. This is a low cost mutual fund, and it's a large cap. It's focus. It's specifically targeting. We go down here, we can read the objective. The fund is aggressive growth fund that is invested primarily in common stocks of not less than 25 to more than 45 companies that fund management believes have a strong earnings and revenue growth and capital appreciation potential also known as aggressive growth company. Under normal circumstances, fund seeks to invest at least 80% of its resources, of its net. And it goes on a little further. I'm not going to go too far because if you follow along and you're going to do this, you're going to read this on your own. But anyway, it shows its previous close, its year-to-date return is at 22%. And where else you gonna get those kind of gains from? It tells you how much it has in assets, its beta, a lot of this stuff you can dig in on your own. But what I want to get to is look at this 1 year return. I actually have this investment. I was told to go out and use a fund finder because I'm what you consider a low uh, account balance holder, and you got to do your own research. When you have a certain level dealing with these investment firms, you have to have a minimum amount of balance to get the advisory services where you can go in. But to me, this is even better. I picked this fund out, but look at what's in it. So the S&P 500 is made up of 500 different companies that represent a number of different industries in the U.S. And in that, there are 7 companies that hold the most pull or the biggest weight. And this investment here has 6 of the 7 in here: Nvidia, Microsoft, Amazon, Apple, Facebook. And right down here, this is where we are at. This Alphabet Inc., this is Google, this is YouTube. So that's 6. Number 7 is Tesla. So right here, with this little investment, at $7.75, you've got the magnificent 7, at least 6 of the companies. And look at the weight over here in technology. It's really heavy. You got a little healthcare in here. Um, their prospectus would have all of the other investments in it. So, and you can look at how well it did. There's different events, like the jobs report will come out, how it affects interest rates, any calamities around the world. Um, so let's see how high this has gotten. Well, it's probably at its peak right now. I actually bought a few hundred shares at $4.15. I had been buying them on a monthly basis as lots, and the investment had lost so much. I stopped buying in 2022 and I switched over to a guarantee because I got nervous. And because of the behavior and the companies that are in here as we're looking at, if that ever happens again, it lose. I'm not going to worry about my capital loss of the value of what it's lose. I'll continue to buy because I know how it's going to behave. Now, the other way you can look at these investments is you can go over here to Morningstar. Morningstar does require you to have a subscription, but it has some information in it as well, and it may be a little bit. So, what you would do at work, you would go through these investments and don't pressure yourself. I mean, if you got 20 of these, you want to go through and pick out the ones that look good to you. The foreign ones, you don't have a clue what's going on with foreign investments, especially over in Asia. I had dumped my Asian investments because they're struggling so much over there. And now they're going to get hit with tariffs. So here's the same thing over here, but this one brings your expense ratio. This is how much they take out of all the gains or the capital gains to run their fund. It's below 1%. I don't recommend you go higher than 1.5. And this is a really good investment. There are investments out there that trade at a whole lot more. What this means is if you're putting away 500 bucks a month and it's trading at about this amount, you're picking up 63 shares out of your $500. Now, let's say that you can only do 250. You're getting 31 shares. So think about that over a 12-month period. You got 383 shares. Now let's multiply that by 3 years. You got 1,150 shares of the top Magnificent Seven investments. How many people are doing that? There are people who got these investments and they're paying per share hundreds and hundreds of dollars. So this is what I have for you on looking up your own investments as a do-it-yourself investor. I hope this is very helpful. I didn't want to get too long-winded. I had this video run. I'm kind of glad my mic went out because I got a practice run and I redid it for you. But let's hop into and look at another investment before we drop off. I'm going to start here and then I'm going to go back to Yahoo. This is my technology fund. I started this 5 years ago. Let's see if it even comes up. Yeah, it's acting funny. Red Oak Technology Fund brings it up. It's trading at $48. I started with 5 grand. I only paid $27, $27.83. So this is appreciated by $21. That's what they're talking about. When you look at this appreciation, that's what they're talking. That's the net asset value. This Red Oak Technology Fund will invest at least 80% of its net assets under normal circumstances in equity securities companies operating in the technology sector as defined by the advisor. It invests primarily in common stocks of U.S. companies, but may, to a lesser extent, invest in equity real estate trusts, common stocks of foreign companies, in America depository receipts. Those are those corporate bonds where they need to borrow money for a project until they get paid by the government or something. Those are those depository receipts, I believe, or money markets. Look at this investment. Year to date, it's up 19.94. Over a year, 39.73%. 3 years, see, it's down because of the 2022, and you get a 5 year return. Look at the holdings. Alphabet, that's Google and YouTube, Amazon, Oracle, that's the database company, Microsoft, KLA, I think they make chips, Facebook, Nvidia, you know their chipment, Synopsys, Broadcom, and Cisco Systems. So you got one, two, three, four. You got five of the Magnificent Seven. Now, your advisors and people you're talking to will say, well, you shouldn't have an investment fund that has the exact same stocks as your other funds. You should mix it up. Rubbish. I want to go with the winners. I know these companies. These are strong companies. They're going to do well. When they go up, my investments are going to go up. I want returns. I don't that diversity. I'm diversifying because I'm going with a technology stock. There are healthcare stocks. There's natural resources. If you're conscious about the environment, there's green. But anyway, let's see if we can get this back up over on the morning side and see what that expense ratio is. Maybe I didn't even hit the search or something, but let's just try. And here it comes up. Now this has expense ratio of 0.94, so it's under 1%. It tells you its total assets. It'll even have the person in here, the names, and it has news related to the investment. And these are the investments. So this is the index. That's the index. Now you can go with a technology index. See how high that is? That's that burgundy. This is your fund, this blue, and this is the category. So here you may say, you know what? I want to go with the index. And here's the companies again. And this is the objective. And that's it. This is how you can start looking up and searching on your own investments and keeping track of them, because sometimes these things turn out to be big time losers and they'll lose all your money. That $5,000 you put in there, and you might want to, before it hemorrhages, it loses a lot more. You may want to sell the shares or move into something else. But as a newbie, this is how you look these investments up and you pick them. Um, Advisor may pick another fund that's trading at $100. Well, your little $500 that you put in, you got 4 shares now. We're here with what I got you. Just think of the MDFOX. What happens to your money when it flips down the road to $15 a share, and you got 1,000 shares. So just something to think about. I'm going to go ahead and end this presentation on the retiring club, and I hope you enjoy this. I suggest you take some likes as well as go ahead and subscribe. And if there's any content that you want me to do study up on and do a deep dive on, let me know and I'll do the research and we'll turn it into a presentation. So this is John with the Retiring Club as we prepare and study and get ourselves up to speed to make financial decisions that are going to make us independent. Thanks. My name is John. Have a good day.